Welcome to episode 12. We're going to be talking about diversification and portfolio construction. The theme to this episode, manage risk without eliminating growth. If there's one takeaway, diversification reduces exposure, not opportunity.
Today we're talking about really building a portfolio of assets. And we're going to look at our friends David and Sarah. And we're going to think in terms of asset buckets and income streams. We're going to organize that into three parts. We're going to talk about risk management at the portfolio level. We're going to look at concentration risk, and we're going to look at time diversification.
So David and Sarah are doing many things right. They're saving consistently, they have retirement accounts growing, but recently they started asking a more sophisticated question. Are we building enough buckets?
Yeah, because their financial life is expanding. They're discussing maybe a possible rental property. They've heard about alternative assets like Bitcoin and precious metals. And they're realizing something important. Diversification isn't just about owning a lot of stocks. It's about building multiple income streams and asset buckets that work together. They wrote down one bucket which had paper assets like stocks and bonds. Another bucket had real estate, and another bucket had alternative assets. And they asked a powerful question. If one of these buckets struggles, do the others keep flowing? That is, again, what we call diversification. And it means spreading your money across different investments so that no single event can seriously damage your entire portfolio.
It's not about avoiding ups and downs. It's about preventing one bucket from determining your entire future. Think about income. Would you rather rely on one paycheck or multiple income streams? The same logic applies to investing.
Your portfolio construction asks a smarter question. How do these buckets behave together? Some move in the same direction and others move differently. When stocks fall, bonds sometimes fall less or hold steady. Real estate often moves in a different cycle, and alternative assets may behave differently as well.
When your buckets don't all move together, combining them can reduce overall volatility. Diversification balances movement.
This is exactly what David and Sarah are evaluating with their potential rental property. Real estate is its own bucket, and importantly, it can create a new income stream. It might provide something like monthly rental income, potential long-term appreciation, and a return pattern different from stocks.
But they also recognize the trade-offs. Real estate is less liquid than stocks. It requires management. Local markets matter. Every bucket has strengths and limitations.
So while they're looking at maybe a rental property, they've also heard about these alternative assets, things like Bitcoin and digital assets. They've heard about high growth potential and how it's portable and it's independent of traditional systems. They've also heard about some of the volatility and the regulatory uncertainty.
They've also looked at gold and precious metals. But even gold and precious metals have pluses and minuses. Some of those pluses could be long history as a store of value, inflation hedge, it's a tangible asset. What are some of the minuses? Well, no income production, storage costs, and slower long-term growth. These are sometimes used as supporting buckets because they may behave differently from traditional investments.
Notice the pattern, no single bucket carries the whole plan. The goal is thoughtful structure across multiple buckets and income streams.
So in summary, being invested isn't enough. Build multiple buckets. Diversification includes income streams, not just assets. Real estate can add a new cash flow bucket. Alternative assets are usually small supporting buckets. Risk isn't removed, it's balanced.
So we're going to move forward a little bit and look at concentration risk. David realized one thing. One bucket was quietly dominating. He owned a lot of stock in the same company where he worked. And this meant his salary was dependent on that company doing well, so were his bonuses and also his retirement. That's a lot of concentration risk.
As their net worth grew, a quiet vulnerability slipped into their financial foundation. They tied significant wealth to a single corporate entity, David's employer. This diagram illustrates their layered exposure. David's primary salary flows directly from his company. His annual bonuses depend on that same company hitting its targets, and a significant portion of his retirement is held in that employer's stock. This is concentration risk. When one bucket dictates a family's entire financial survival, an isolated industry downturn can simultaneously cut off every income stream, shattering the system you've built. A company's current strength offers no long-term protection. Market cycles rotate, competition increases, and technology alters entire industries. Being invested offers a false sense of security if the entire system lacks redundancy and can be collapsed by a single isolated event.
Concentration risk is having too much exposure to one thing. Or in our language today, one bucket that's too large. One employer, one industry, one country. If too much of your financial life depends on a single outcome, your risk increases.
Yeah, exactly. And then Sarah was thinking, she was connecting the dots and thought, we don't want one bucket carrying this whole family because markets change and so does technology and competition increases. Even the place David worked is not guaranteed to be there forever.
That's right. Diversification doesn't mean you don't believe in something. It means you respect uncertainty. It's not fear, it's wisdom.
So in summary, concentration risk equals maybe one bucket is too large. Layered exposure increases vulnerability. Even strong companies can face uncertainty. Smart investors build balanced buckets.
And so, like many investors, David and Sarah once wondered if they should wait for the perfect time to invest. But they learned something important. No one consistently knows when the exact market top or bottom will occur.
And that leads us to time diversification.
A sudden market correction the following week can instantly erase years of hard-earned savings. This chart shows the danger of relying on a single entry point. We solve this through time diversification, filling investment buckets steadily over long periods rather than all at once. By automating their contributions month after month, David and Sarah purchase assets during market highs and market lows, smoothing out the average cost over time. They replace the high-stress gamble of perfect timing with the reliable mathematical certainty of consistency. Time diversification turns duration into an advantage. Systematically buying over decades ensures that no single bad month can derail their long-term progress.
So in summary, time diversification is filling buckets consistently over time. You don't need perfect timing. Markets move, consistency builds. Over decades, duration matters more than prediction.
So David and Sarah step back and they review their full picture. They reduced concentrated employer exposure. They maintained diversified stock and bond buckets and carefully evaluated a rental property for cash flow. They considered small alternative asset allocations like Bitcoin or possibly some gold, and they committed to steady monthly investing. Nothing dramatic, but structurally stronger.
So portfolio construction isn't flashy. It doesn't spike 40% in a month. It doesn't make headlines. It's disciplined. It's steady bucket management. It's rebalancing when it's boring, and it's sticking to structure when something else looks more exciting.
Today wasn't about chasing the next big thing. It was about building something that can last. We talked about diversification through these buckets and income streams.
And we talked about concentration risk and why one oversized bucket increases vulnerability.
We talked about time diversification, filling your buckets consistently over time.
Because you don't need to predict the future. You need to prepare for multiple futures.
Because diversification builds resilience, and resilience builds longevity.
So, Andrew, would love to hear, in your experience, have you kind of encountered any of this?
I loved at the beginning when we talked about David and Sarah, and they said, oh, we're invested in the market, but really looking at what you're invested in. In last episode, we talked about stocks and bonds and that kind of deal. And this time we talked about alternative investments and maybe even real estate. And for a lot of years, I was investing in retirement, but I honestly had no clue what that meant. I just was doing time diversification, putting money in monthly, but I didn't know what I was invested in. And so probably it took like 10 years for me to actually dig into, what am I invested in? What does my retirement account look like? And I realized, man, it was severely underperforming. And the bummer is if it's underperforming for a number of years, you don't get that compounding time back like we've talked about before. And so I fixed it, thankfully, and I've seen much better returns because I was in a lot of bonds that I didn't need to be as a young guy. Bonds are more for older folks, and I needed to be in more growth stocks. So being able to look at what you're actually invested in and having some buckets of growth stocks, having a bucket of maybe Bitcoin, having a bucket of gold, all of these things can help build the infrastructure of your portfolio and see it succeed.